Your portfolio doesn't need a market crash to underperform. Sometimes it's quietly bled by fear. In today's video, I'll show you exactly how a typical 0.68 active fund versus a 0.22 index fund can cost you over £500,000 over time. And I'll show you exactly how to plug that leak. Here's what we'll do today. First, why this matters. Tiny fees can snowball into six figures over time. Second, what the numbers show. We will compare 0.68% versus 0.22% at 8% growth with clear examples. Third, what to do next. I'll give you a simple 5-step fee check and a tidy, low-stress way to keep more of your returns. Hi, I'm Yemi, your financial coach and guide to smart money decisions. Before we dive in, if you want to learn more practical tips on managing your money better, make sure you hit that subscribe button and tap the notification bell so you don't miss any future videos. In the UK, the main fee inside your fund is the ongoing charge figure. It is deducted within the fund, so you never pay it directly. It just quietly reduces your return. Then there's your platform fee, either a flat charge or a percentage. Add trading frictions and the occasional stamp duty on UK shares, and your true all-in cost can be higher than the headline OCF. The goal isn't zero fees. It is smart, low fees, especially for the core of your portfolio. Let's compare like for like. Scenario A. A portfolio that started with a lump sum of £500,000, growing at 8% before fees for 30 years. With a 0.68% fee, which is typically for active funds, you earned near £4.16 million. Compared to an index fund with a 0.22% fee, you earned near £4.73 million. That is a whopping difference of around £570,000. Scenario B. Starting with a smaller lump sum of £10,000, growing at 8% before fees for 30 years. With a 0.68% fee, again for an active fund, you earned near £83,000. Compared to an index fund with a 0.22% fee, you earned near £95,000. That is a difference of around £11,000. Scenario C, where you are investing £500 every month, growing at 8% before fees for 30 years. If it is invested in an active fund with 0.68% fee, you end up with £620,000, compared to when it is invested in an index fund with a 0.22% fee, you end up with £676,000. That is a difference of £56,000. So, why are fees invisible? This is because we notice shocks, not drips. OCF is shown in decimal. It is deducted daily inside the fund, and platforms display values after fees. So there are no invoices to react to. And this is why even sophisticated investors still overpay without realizing. Here are the 5-step fee check I use with clients. It's quick and it puts real pounds to the percentage. Step 1. List your holdings. Write down every fund or ETF you own and its OCF. You will find the details on the fact sheet. Step 2. Note your platform fee. Is it a percentage or flat fee? For example, £4 a month, whatever the charge is, keep that handy. Step 3. Calculate your weighted fee. This just means we weigh each fund's OCF by how much of your portfolio it represents, then add the platform fee. So, weight of a holding is equal to value of that holding divided by the total portfolio value. Weighted OCF in percentage, OCF of each fund multiplied by its weight. Total fee is equal to the weighted OCF plus platform fee if it's in percentage. However, if your platform fee is a monthly fee, first convert it to a percentage. Step 4. Set a target for your core. Aim for around 0.2 to 0.25% OCF on the core of your portfolio. Step 5. Make a tidy switch. If your core is expensive, replace it with broad, low-cost UCITS tracker and keep any active ideas as a small satellite. Think about it this way. Core will be low fee, globally diversified, and satellite will be limited, intentional bets. Now, let's explore platform fees and what to compare. Platforms matter, and you want to compare platform fees and understand if you are charged flat fees or percentage fees, FX costs, fund or ETF range, ISA availability, transfer process, customer service, and app experience. Popular UK options include Trading 212 that has the ISA option, Vanguard, Fidelity, Agris Lansdowne, Invest Engine, and lots more. Which one is the best? That's another can of worms and a story for another day. Comment platform breakdown below if you want that video. So, tax wrappers and how they can be used to shield fees. Outside tax wrappers, dividends and gains can be taxable. So where possible, use ISAs, LISAs, and SIPPs so compounding isn't interrupted by tax. Tax wrappers beat structure. An efficient ETF is good. An efficient ETF inside an ISA or SIPP is even better. So, here are your action checklists. List funds and OCFs. Add your platform fee. Calculate weighted fee, either percentage or flat fee cost. Target between 0.20 and 0.25 for your core. If your core looks pricey, swap that into a broad, low-cost tracker and keep any active ideas as a small satellite. Think core will be equal to low global fee and satellites will be limited, intentional bets you can review once a year. Rebalance annually or when allocation drifts around 5%. If you want help getting started the right way, I offer a free 30-minute one-to-one money Kickstart coaching where we will calculate your weighted fee, map a low-cost core you can stick with, and shortlist sensible platforms for your need. Grab a slot here at caresconsultingpro.com/book. I have limited weekly availability, so grab yours now. Let's move on to the next question. Does active beat passive? The answer to that is sometimes, but very rarely and unpredictable after fees. A few active funds do outperform for a period, but once you factor in cost and taxes outside wrappers, most of them don't sustain that edge over the long term. Finding the exception in advance is a bit like finding a needle in a haystack. If you enjoy the active tilt, keep it small, maybe about 10% as a satellite, and keep your core low-cost broad market index fund in order to do the heavy compounding. That way, your fee stays controlled whatever the market does. Remember, I'm not saying you must avoid active funds. If you're convinced by a manager or a style, that's fine. The key is to keep it small and keep your core low cost. Over long periods, most active funds don't beat market after fees. How about choosing a platform? Choosing platforms is like discussing football teams. Everyone's got a favorite. We'll save that debate for another video. But please don't let this be a reason to delay investing. Start with a sensible low-cost option. Keep learning, and remember, decisions are not final. Switching platforms is doable. You can transfer as cash or sometimes transfer your holdings in specie without selling. The important thing is to begin and keep fees under control. Tonight, I want you to calculate your weighted fee and drop the number in the comments. I'll reply with ideas to lower it. Also, watch these next videos, investing and wealth building. Links are in the description. And if you want personalized help, book your free 30 minutes one-to-one Kickstarts at caresconsultingpro.com/book. Let's make your money work smarter, not harder. And if you're finding this video helpful, like, subscribe, and turn on notifications. I share new money saving strategies every week that you don't want to miss. Just a note, this video is for education, not personal advice. Markets go up and down and your capital is at risk. But with a diversified, low-cost, long-term approach, you can manage risk sensibly. Thank you and see you soon.